Well, there's been a lot of talk lately about whether gold is still doing its job, whether silver already made the big move, and whether this latest jump in precious metals is the start of something even bigger, or just one more fake out before another shakeout. So, in this video, we're going to separate the headline noise from the deeper story, and you're going to walk away feeling a lot smarter and more confident in what may be coming next. And by the way, today is Saturday, April 18th, in New York. So comment the day and date you're watching from. And real quick, if you value what I do here, subscribe and comment John A.G. Best. It helps more than you think. Also, yes, I'm doing the silver giveaway again this month. I'm pulling roughly 20 ounces from my personal stack. And to get in, hit like, subscribe, and drop a comment with either your favorite kind of silver or where you think silver ends this month. Last month's winner got about 30 ounces, and that package is already on the way. Now let's get into the bigger question, because this is where people start getting twisted up. Because once you see the layers, the price action starts making a lot more sense. A lot of folks look at gold and silver, see a huge run, then a sharp drop, then a choppy base, then another jump, and immediately try to force one clean explanation onto all of it. War did it, the dollar did it, inflation did it, central banks did it, rate cuts did it, and the truth is no, not exactly. Markets like these are not one-engine airplanes. They're more like a whole dashboard lighting up at once. So when somebody says, if gold was really a safe haven, why didn't it just go straight up and stay there? That sounds smart on the surface. It really does. But it skips over something important. A reserve asset is not just something you hide in. Sometimes it's something you use. Because in a real stress environment, countries, institutions, businesses, and even regular people don't sell what they hate first. A lot of times they sell what still has value, what still has liquidity, what still gets respected when everything else starts looking shaky. That doesn't mean the asset failed. In a weird way, it can mean the opposite. Think about it like this. If somebody's house is on fire and they run for the emergency cash box, you don't say it failed because they opened it. You say that's exactly what it was there for. Gold works a lot like that in moments of stress. It can be a shield, yes, but it can also be a funding source when the bill comes due faster than governments and markets want to admit. And we've seen enough lately to know this isn't some abstract theory. Based on recently published numbers, gold demand last year hit a record in total value terms, investment flows were very strong, and central banks kept buying even after all-time highs. In just the first couple months of this year, official buyers were still adding to reserves. That is not what a dead asset looks like. That is long-term trust, even when short-term price action gets messy. Now, silver is a different animal. Silver does not move with the same personality as gold. It just doesn't. Gold is broader, deeper, steadier. Silver is smaller, more industrial, more emotional, more explosive. So when silver rips, it tends to rip harder. And when silver gets smacked, it tends to get hit harder too. That's why people get seduced by it right at the top and scared out of it right near the bottom. So when you see silver skyrocket, the wrong question is, did I miss it? The better question is, what kind of move is this? Is it just a squeeze? Is it just a fear burst? Is it just a momentum stampede? Or is it a warning shot that the market is starting to price in something bigger, something monetary, something structural, something that doesn't go away just because we get one calmer news cycle? And that brings me to the interview I want to unpack. I had a conversation with someone who runs a platform built around buying, holding, and spending physical gold like money. That matters because when you talk to somebody living inside that space every day, you don't just get the usual talking points. You start hearing how people are thinking about metal not only as a trade, but as a backup plan. And his main argument was simple. The headlines keep screaming about conflict, but the deeper story is debt, deficits, refinancing pressure, and a monetary structure that is getting less forgiving, not more. In other words, the war story grabs attention, but the balance sheet story is what keeps the pressure on, even after the cameras move on. I think there's a lot of truth in that. Look at where we are right now. The federal debt is pressing up around the 39 trillion range. A large chunk of marketable debt comes due within about a year. The official budget outlook still shows a deficit this year around the high 1 trillion area, and net interest alone is already around the 1 trillion mark for the year. That's not a normal backdrop. That's a system trying to keep its footing while the floor keeps shifting underneath it. And here's the part people don't always appreciate. When debt gets this large, you don't need an overnight collapse for metals to matter. You just need the market to slowly lose confidence that the future currency unit will hold purchasing power the way people assumed it would. That's enough. You do not need fireworks every day. You just need an ongoing leak in credibility. People keep acting like gold only counts as a safe haven if it rallies every single time missiles fly or a politician says something reckless. But that's not how real markets work. Gold can wobble in the short run because liquidity gets tight, because the dollar catches a bid, because yields back up, because traders take profits, because funds sell winners to plug holes somewhere else. none of that erases the bigger role gold plays. In fact, one overlooked thing this year is that gold volatility has gone up, but liquidity has still been there. Trading volumes have stayed strong. Two-way action has stayed strong. So the market hasn't disappeared. It's just been forced to digest a lot more stress in real time. That's very different from saying the thesis is broken. Now, let me challenge one thing, though, because I don't want us getting lazy with bullish arguments either. Not every sale of gold is bullish. Sometimes gold gets sold because somebody is in trouble. Sometimes it gets sold because yields are attractive elsewhere for a while. Sometimes it gets sold because a central bank or a fund needs cash now, not because they're making some grand statement about the future of money. If we turn every downtick into a heroic bullish signal, we stop thinking clearly. So the better interpretation is not, every dip proves the bull case. The better interpretation is, the reasons gold gets sold during stress often do not invalidate the long-term case for owning it. That's the more mature view. And silver sits right next to that story, but with extra fuel on the fire. From recent market updates, the global silver market is still expected to run another structural deficit this year, which would make it several years in a row. Coin and bar demand has been helping offset weaker industrial demand, and inventories have already been drawn down hard over the last few years. So even if the path is wild, the setup is not exactly screaming abundance. That helps explain why silver keeps behaving like a spring with too much tension in it. And if you're successful, share your success story in the comments so others can stay motivated. Now, another part of that conversation went in a direction I think more people need to hear. Gold is not only about price appreciation. That line gets missed all the time. A lot of investors talk about gold as if the only reason to own it is because they hope the chart goes up. But resilience has value even before the chart bails you out. Optionality has value. Portability has value. An asset outside the promise structure of the financial system has value. That's why gold stays relevant even when it frustrates traders. And silver, while more volatile, taps into some of that same psychology. It just also carries more industrial sensitivity, which is why it can act more like a high beta cousin than a direct replacement. So what happens next? Well, here's the clean, simple answer. Simple. I think the next phase depends less on one battlefield headline and more on whether investors start focusing again on the long arc of debt, refinancing, interest expense, and the quiet loss of faith in paper promises. If they do, then gold likely stays structurally supported, and silver can keep overshooting in both directions on top of that. But there's another layer here that most people still think is fringe, even though it's becoming harder to ignore: state-level movement. Over the last year or so, multiple states have moved in some form toward recognizing gold and silver more directly in commerce, taxation, or legal tender treatment. Texas passed a law recognizing gold and silver specie as legal tender and building out a transactional framework. Florida moved to recognize gold and silver as legal tender and set up regulation for custodians. Utah passed legislation this year pushing toward a precious metals-backed electronic payment system. Missouri has also been active on legal tender language and on easing tax treatment for specie. Now, am I telling you that means America wakes up tomorrow on a gold standard? No, absolutely not. That would be sloppy thinking. These moves do not mean the paper dollar disappears next week. They do not mean you're buying groceries everywhere with silver coins by Friday. And they do not erase federal power or federal taxation issues overnight. But they do mean something. They tell you the idea of using precious metals in a more transactional way is no longer just a niche internet debate. Lawmakers are testing it. States are testing it. Payment infrastructure is being discussed. Tax questions are being discussed. And once that door opens a little, people start asking bigger questions. Why should moving between dollars and transactional metal trigger a tax headache if the metal is being treated more like money? Why should savers be forced to sit inside a system that rewards the people closest to credit creation, while everyone else watches assets run away from them? Why should resilience be treated like speculation? Those are not crazy questions anymore. And this ties into one more issue that sounded speculative a year or two ago, but looks more concrete now: stablecoins. A lot of people hear stablecoins and think the story ends at crypto. It doesn't. The law signed last summer requires one-to-one backing and allows reserves like cash, money funds, and short-term treasuries. So yes, there is a real sense in which broader stablecoin adoption can help create demand for short-dated government paper. That doesn't solve the debt problem, but it can buy time. That's why I think the bigger game right now is not immediate reset. It's extension. Patch the system. Stretch the timeline. Create new buyers where you can. Keep confidence alive as long as possible. And while that's happening, people who are paying attention start building parallel resilience. Some do it with cash, some do it with land, some do it with businesses, some do it with gold, some do it with silver. The point is not to panic. The point is to stop pretending the current arrangement is permanently self-healing, because it isn't. The official budget outlook says the fiscal path is not sustainable. Treasury is still borrowing huge sums quarter after quarter. Interest expense keeps eating a bigger piece of the pie. And the market still has to absorb refinancing on a very large scale. You can debate the timing of the strain. You can debate which trigger matters most. But the direction of pressure is not subtle anymore. And that matters for precious metals because markets eventually start asking a different question. Not, what is gold worth? But, what is the currency worth that we're measuring gold in? That is a totally different conversation. And once people start thinking that way, the chart can move a lot faster than most are comfortable with, especially in silver, because silver doesn't do gentle repricing very well. It lunges, it flushes, it spikes, it scares people. Then it reminds them why they were watching it in the first place. So no, I don't think the recent action means the story is over. I think it means the market is still trying to decide which part of the thesis it wants to price first. The war premium, the inflation risk, the debt burden, the rate path, the state-level monetary experimentation, the stablecoin treasury bid, or the simple fact that trust in fiat systems tends to erode slowly, then suddenly. My answer is probably some combination of the above, which is exactly why these moves feel so violent. Before I wrap this up, quick reminder, stay subscribed here and keep an eye on the comments section because that's where I see what you're thinking in real time. And to get in on the silver giveaway, you know what to do. Here's the bottom line. Gold does not have to act like a perfect straight line to remain a safe haven. Silver does not need to go up every week to remain explosive. Debt does not need to implode overnight to keep undermining confidence. And state-level precious metals legislation does not need to flip the whole system tomorrow to matter today. Those are 4 different truths people keep mixing together. Separate them, and the picture gets a lot cleaner. Gold still looks like the steadier anchor. Silver still looks like the faster horse. The debt machine still looks overextended. And the policy response still looks like delay, patchwork, and experimentation rather than final resolution. That is not nothing. That is big. And if the market keeps drifting toward that realization, then the next chapter in precious metals may not be polite, may not be linear, and may not give people much time to get comfortable before it starts moving again. That's why I'd stay humble, stay alert, and stay flexible. This is for education and discussion so you can think clearly about the market. It's not personal financial advice, and you should make your own decisions based on your own risk, your own goals, and your own homework.